To succeed as an investor, what's the most important thing you need to get right? Picking the right stocks? Guessing which way the market's headed? It's neither. Instead, it's the unglamorous job of portfolio management, allocating your assets among stocks, bonds, cash, real estate, and other categories of assets. To help us get our minds around this counterintuitive finding, we're joined today by Mitch Tuchman, CEO of MarketRiders, one of a number of companies that aims to help ordinary investors construct smart portfolios. Mitch, thanks for joining us.
Thanks for having me, Eric.
If I had put my money this year into the China small cap ETF, I'd have doubled my money. If I'd put it into GM, I'd have been wiped out. How could that not be more important than my asset allocation?
Well, I would ask you, how did you pick China or how did you pick GM? And you probably would have said to me, well, I had an idea, I had an inkling. And at the end of the day, it probably would have been a guess, with all due respect. And that's not what investing's all about. It's not about guessing. It's about using a systematic approach to taking care of your money and taking care of your family.
But Wall Street's heroes are people like Warren Buffett and Jim Cramer and Bill Miller, people who pick the right stocks and hit home runs. Why shouldn't ordinary investors try to imitate them?
Because I believe that a lot of that is a machination of the media and Wall Street to subtly convince individual investors to pay them fees to help them engage in something called stock picking and market timing. If you talk to the wealthiest families and the most elite institutions in the world, what you've described is not at all how they think about investing.
They think about how to allocate their assets?
They think about asset allocation because what they understand and what we try to help people understand is that 90% of your returns come from where your money is placed as opposed to which stocks you're picking and how you're timing the market. For example, Eric, what if you had all your money in bonds at the beginning of last year? You would have done fine, right? That would have been an asset allocation decision. But that had nothing to do with a Jim Cramer decision or a stock picking move.
Okay, yes, I'd have been happy if I'd had all my money in bonds. I did not, for the record. You advise people to put money in ETFs. When you construct portfolios for your clients, you put it all into ETFs. Why?
ETFs are wonderful vehicles. They are a better version of an index fund. And what most people I talk to don't understand is the difference between an index fund and an actively managed mutual fund. But A, we are absolute diehard indexers. We believe in indexing. And an ETF is a great method for indexing. It gives you many, many options, and it also gives you great tax efficiency. And you can buy and sell them in an online brokerage account for very little money.
Okay, and an index fund is a fund that tries to match an index and not try to outperform the market.
Yeah, you're basically paying very small amounts of money, like 1/10 of the money for a computer to buy all the stocks in a given group that you define, versus an active mutual fund, like a Bill Miller. You're paying a whole staff of smart MBAs and physicists to run around the world, meeting company managements, doing research, and you're paying a lot of money for that effort, which has been proven to result in no results for the investor.
One of the important inputs to any kind of asset allocation plan is your risk tolerance, but that's kind of a fuzzy concept. How do you make sure people get it right?
Well, it's risk tolerance and it's time horizon. So depending on your time horizon, your risk tolerance has a lot of variance. So if I tell you, look, this money, Eric, you don't have to worry about for 20 years because you can't touch it, it's in an IRA, you're probably not going to have as tough of a time with volatility like last year. So we try to marry the two ideas together. But it's a tough thing to get right, and it's a very personal decision, and you almost have to experience a market like last year to really understand it emotionally.
When you look at a portfolio asset allocation plan, it says 45% in this and 7% in this and 3% in this. How important is it to get that exactly right?
Well, it's really important. It's important because the more asset classes that you have in a portfolio, and by the way, I didn't make this up. I'm giving you a synthesis of probably 30 books I've read on the subject by Nobel laureates, people you've interviewed, very, very smart people, much smarter than me. But the wisdom is you need to have exact allocations to several different asset classes, namely 6. And it's important to get those right, particularly your split between fixed income and everything else. And then once you've allocated those specific asset classes, it's important to rebalance. And rebalancing is the whole key to portfolio management.
Okay.
And so it's not just getting it right at the beginning, it's keeping it right over a long period of time.
Mitch, thanks for joining us.
Thanks for having me, Eric.
I'm Eric Schurenberg for CBSMoneyWatch.com. Thanks for watching.